Hello there. Welcome to today's Five with Fitz. It was great to recharge over the weekend. Thank you for giving us the space to do it. The team and I have been in overdrive for months with all the market madness, and it was great to get a brain check. So anyway, here we go. Earnings season is upon us, and I tell you, for the first time and as long as I can remember, the math won't matter, meaning the results. It's going to be all about what management says next, tech especially. Now, this is very much still an event-driven market, and that's why you want to think very, very carefully about how you invest under the circumstances. Now, something I spoke about in last night's short. You can find that elsewhere on the channel. Always buy the best, ignore the rest, especially right now. So here's my playbook for today. Number one, have the markets bottomed, and what's up with Apple? I sat down with the superstar smart Stuart Varney ahead of today's opening bell, and he asked me what was going on with Apple and whether the markets have now bottomed. I think there's a good case that's in effect. I think that that's happening. But I also think that Apple is very, very self-explanatory for reasons you want to watch out on the video. Again, in another place in the channel, but here's the cheat sheet. Apple is one of the most widely held, most liquid securities in the world, which means that if there's any kind of rally whatsoever, every big hedge fund, endowment, pension fund, etc., has got to own, hedge, or trade Apple, so they're going to come a running. Number two, no surprise that the trading titans struck again. Goldman Sachs reported a 15% earnings increase in Q1 2025 profit, driven largely by a jump in equities trading revenue. Goldman follows peers JP Morgan Chase and Morgan Stanley, which also reported trading gains last week. So talk about a hat trick. I'm not surprised, and I trust you aren't either. Last week was among the most volatile on record, certainly over the past few years, which means that once again the pros are raking in profits hand over fist where retail investors fear to tread, present company excluded. And it's been much the same for the past few months. Now, I really hope that you've been smart about it. Heck knows, we have talked about this enough. You always do what Wall Street does, not what it says. And here's a trade idea. Maybe if you're beginning to think like a shark and not a minnow, maybe Goldman Sachs going to pull back to the 450s if you're a trader. But if you're an investor, you want to stick with the one bank, and I mean it, the one bank that I submit actually understands money. Now, it's returned 99.32% since I brought it to the OBA family's attention versus 35.13% from the SPY, which is a popular ETF indexer's choice over the same time frame. That is a 2.82x performance advantage, nearly 3 to 1. Now, hopefully, you've taken a similar approach with similar names in your portfolio, and if not, and you'd find that helpful, you know where to find me. I'm not here to sell you anything, but again, if you are not thinking along these lines and thinking about the best and ignoring the rest, I submit you're going to have a problem. You're going to come up short. So always flip that around, especially in today's markets. Number three, Pfizer pulls back, but I don't think it's time to pull the plug. Pfizer made headlines this morning for ditching its once daily oral GLP-1 weight loss drug, danuglipron. And I don't think I'm pronouncing that even remotely correctly, but they pulled it after one trial patient showed elevated liver enzymes. Now, cue the headlines, the hand-wringing, the knee-jerk sell-off, the hype and the hysteria. Here's what most folks miss. Number one, the patient had no symptoms. Number two, the liver markers recovered quickly. And number three, there are similar issues already shown in other GLP-1 drugs that are still on the market. So this isn't a blow-up, it's a reset. Pfizer's pipeline still includes a GIPR targeting obesity drug, potentially better tolerated and even more effective. So again, I think the game's far from over. Remember this piece of Fitzwitz if this bothers you or you're thinking about Pfizer. The winners aren't always first. They're the ones that are left standing after the hype fades. So if you're an investor, keep an eye on Pfizer under 26 for a value-focused entry, or consider nibbling into leaps if you got the patience to wait for a pipeline payday. And, by the way, that might be a great idea anyway. And number four, I always hate the expression, I told you so. I'm not going to say I told you so, but I did. So what I want to say today is, what have I been saying about tech? That the fear was totally overdone and that tech prices would vanish like a shot the moment we got any kind of clarity whatsoever. And the president's temporary exemptions on key chip restrictions, yeah, those definitely qualify. So continue to look for entries on weakness. Just don't expect a lot of weakness. My POV, I've been a broken record on this stuff, and I hope that you've done something about it, like not going to the sidelines. Investing in optimism beats cowering in fear. Any day, every day, over long swaths of time. I mean, just always think forward. And on a related note, NVIDIA, I think it's very interesting, will be investing in the U.S. to build its next-gen AI chips. And I bet you dimes to dollars there are going to be other companies that follow. And finally, number 5, why China's next move could be great for smart investors. I've been talking about this since 2010. China wants to make its capital markets the best in the world, and it needs Western expertise to do that. Now, not surprisingly, China is evaluating a plan to allow major Western market makers like Citadel Securities, Jane Street, and Optiver to operate in its $520 billion ETF market to help with liquidity and efficiency. And yeah, I know they supposedly hate our tariffs and all that stuff, but this is the reality of modern China. Pragmatism over politics, especially if there's a yuan or two, their currency, to be gained in the process. Now, if this goes forward, and I think it will, it could help reshape how big money flows into China. The last major step, by the way, will be U.S. companies listing in China, which will ultimately happen using some equivalent to U.S. ADRs, which are offshore companies use to list in the U.S. presently. And that could be great for U.S. investors for the simple reason that billions of dollars will come rushing into U.S. shares and on a previously unimaginable scale too. So, Keith's investing tip in this circumstances is from the Broken Record Department. Invest because of China, not in China, and with very few exceptions, as noted in the OBA model portfolio. So today's bottom line, people don't fail in the markets because they're stupid. They fail because they can't focus when it counts. So you know what to do, and as always, let's make it a great day and start the week strong. You got this, I promise, and I will see you tomorrow. Thanks for watching.